doing a little bit of risk analysis here today and helping you to find out whether you should trade Tesla or you should trade Coca-Cola, and not necessarily trying to compare these two to find out what's the better buy. Obviously, they're very different companies, but the reason that I'm pitting them against each other is because in terms of risk and what you should invest in or day trade in, these are really the two different sides of the spectrum here. Tesla being a very volatile, high risk, high reward stock, Coca-Cola being the opposite. And so I wanted to look at stats around these two different stocks, just to give you obviously a very straightforward basis if you wanted to compare the two, but more specifically, just look at what the effects of investing in or trading these two different types of stocks, given their very different volatility. And you can see here, if you just look at the chart in your platform, they're trending in the same direction, which is since the start of the pandemic here, for the last about 3 years of trading, they're both higher. And it's funny, it's almost an illusion. If you look at that black line, which is Tesla, you might think, oh man, Tesla is not as high as Coca-Cola here, because it's fallen in the last year or two of trading. It's fallen from $400 a share all the way down south of $200 a share. But since the start of the pandemic, Tesla is actually up way more than Coca-Cola on a percentage basis. And that's because it appreciated eightfold in value from $50 a share to $400, and then was more than cut in half, but still in the last 3 years would have been a better return, better bang for your buck. But you would have taken a lot bigger swings. Like if you had invested, say, in the start of 2022, you'd be down more than 50% on your investment. And so it's this idea of integrating risk helps you get a better view of whether you should be investing or trading in whatever stock, because it's not all smooth sailing. Even if you are investing for the long term and you're saying to yourself, I'm not going to touch this position for years and years and years, sometimes you'll look at that position and you'll be like, man, I'm out 60% on this. Maybe I do need to touch it here. And that risk is very, very real. Whereas Coca-Cola has gone from $45 to $65, still a hell of a run here. And amid all of that, has only at its worst lost about 10% from its peak at 65, fell all the way down to just lower than $55 a share. And so, yes, better return for Tesla, but very different risk profile, and the return relative to that risk a lot lower than just that risk number. And let's see what that looks like if you were to put a position on in both these markets here today. Tesla trading at $180, Coca-Cola at about a third of that. But you bring in the volatility piece of this, and this is what a lot of traders and investors will use to project, how much a market will move, and thus how much upside you have and how much downside you have, as those things are equal and opposite theoretically there. And you could see Coca-Cola with the smaller stock price for one, but more importantly, I think for today's conversation, the volatility piece being, less than a third of Tesla's here. You have a day-to-day range of Tesla of more than $5, or if you have 100 shares, $500 moving around in your account, whereas Coca-Cola, it's 50 cents. On a monthly basis, this range in Tesla is going to be plus or minus $30, or on 100 shares, $3,000. And in Coke, it's about a tenth of that. You can, of course, play this out on a yearly basis, where Tesla is a $180 stock that's moving about $100 in a given year. And we just looked at the last 3 years, and it's a market that's gone from 50 to 400 down to 100. Now it's trading around 200. So yeah, absolutely can move $100 in a given year, whereas Coke is usually usually moving around $10 in a given year. And so this isn't to say, of course, that you should go with the lower risk option all the time. If you're looking for, day trading or swing trading, multi-day, shorter term strategies, then Coca-Cola moving 50 cents in a given day might not be what you're looking for. But if you are looking for lower risk and yes, lower potential upside, given these numbers, then yeah, Coca-Cola is much lower risk than Tesla, given historical trading and given the current options market that's pricing the future range for this. And then I also wanted to just quickly calculate what, a 1 standard deviation and 2 standard deviation move would look like for $1,000 investment over the course of a year for these two different stocks. And keep in mind that, 1 standard deviation is more or less like where most of the outcomes lie is within 1 standard deviation. And 32% of the time, your outcome will go beyond that 1 standard deviation. And then 2 standard deviations I give as just as kind of an outlier type scenario where 5% of the time it could go that far. And you see here $1,000 in Tesla. 1 standard deviation most of the time means after a year, your investment either being at $450 if it was a bad year, or $1,550 if it was a good year. And so that's what you could, given these historical values and everything, could expect most of the time from a Tesla investment. Coca-Cola, obviously going to be a lot different. Your $1,000 could move lower to $840 or up to $1,160. And in that outlier mode, and this is where things get interesting and why, a lot of people who are more accepting of risk might like a Tesla versus a Coca-Cola, but people who are more averse to risk might like a Coca-Cola versus a Tesla, is the outlier chance that Tesla has a 2 standard deviation move, a big move here. It's the difference between this stock more than doubling or going down to close to zero here. And that's a very real possibility. This is a market similar to a cryptocurrency, if you will, that can double, can quadruple at one point from the start of the pandemic to 2 years ago. In the span of a year or two, Tesla appreciated 8-fold, was up 800%, and then got more than cut in half. Whereas Coca-Cola, even in those outlier circumstances, would likely only change your $1,000 investment down to $680 or up to $1,320. And then, we're talking about with that Coca-Cola, that's an implied volatility of around 15%. So annually moves around 15% plus or minus. Tesla, higher volatility, implied volatility of about 55%. So on an annual basis, either appreciates by 50% or gets cut in half. Then you have stocks like Dish, which are even more volatile. It's the highest volatility stock in the S&P 500 with an IV of more than 150% currently. And that's the difference between a stock literally losing all of its value or more than doubling, appreciating by 150% here. And so a good place to start whenever you're assessing risk is that volatility piece coming from the options price, or just go into the chart. I mean, you don't need the volatility of the options on Dish to look at this chart and say, yeah, that's a stock that might be either going to zero or could double back to 15 or $20 here in the next year. And so I like using Coca-Cola and Tesla as those two polar opposites for the least risky and most risky types of stocks, not necessarily comparing them directly, but should look at assessing your risk whenever you're making a decision between trading, investing, or whatever you're doing in any market.